And Ms. Arundhati Bhattacharya, Chairman at SBI, joins us on the show. Ms. Bhattacharya, hi, morning. What's led to the decline in your profit growth this quarter, and what's been the main reason for lower profit? If you could throw light on the provisions you've made this quarter as well.
The decline YOY is on account of the fact that, of course, our NPAs numbers have gone up. So, therefore, provisions have gone up. Provisions have also gone up on account of mark-to-market in the investment book. These are the two things. On the other side, also, we have seen quite a bit of increase in the expenses. Now, the expenses have mostly gone up in the staff side. Staff side, in view of the fact that we have started making provision of 15% for the 10th bipartite that is currently going on, and which has not yet actually been implemented, but will be implemented effective from November of last year. There is also an increase in the pension provision on account of the fact that LIC has changed its actuarial tables to increase life expectancy from 76 years to 81 years. Other than that, also, we have seen quite a sharp increase in other expenses. These also can be accounted by the fact that we have grown in our branches, in ATMs, in many of our networks. So all of these expenses have kicked in, but they have not resulted in the kind of bottom line growth that we would expect to have got. And as a result of all of these increased expenses, increased provisions, we are seeing that the bottom line is impacted.
But your fresh slippages have been contained, but gross NPAs are still above 5%, which clearly are above the March level. So what has led to this, and which sectors have contributed to this, and how do you plan to contain fresh slippages?
The gross NPAs, are contributed by a number of sectors. Infrastructure is there, power is there, iron and steel is there. Some other miscellaneous sectors like IT, I think there was one big account. But most of the slippage has come from a few major accounts. It is not a sector that has contributed to it. It is more chunky accounts, one or two of them that have slipped, that have contributed to this number. Some of them might get restructured in view of the fact that it has been referred to CDR, but if the promoters are able to meet the conditions that are there in CDR, then it might get restructured. If they are not able to do it, then viability cannot be established, and obviously we will not go in for restructuring. So I think these are the major things that have happened for the slippages that we are seeing this quarter.
Right, so give us a sense of your treasury hit this quarter. What kind of MTM hits have you taken, and going forward, will this improve?
Actually, the entire treasury hit that we could amortize is in the range of 2,100 crores. So around 700 crores we have accounted for this quarter. Going forward, 2 more quarters of 700 crores will take, but there is a plus or minus. As a result, what has happened is that the domestic book needed about 237 crores. On the foreign book, actually, we could write back around, I think, 225 crores or so. So the net impact that has come in is only 8 crores. But in the next 2 quarters going forward, we still have unamortized amount of around 1,400 crores, which will need to come in the next 2 quarters.
But your credit growth has been very strong on the corporate side. Why is that, and what are your projections for credit growth going forward? And are you also seeing some kind of a slowdown in any of the key corporate verticals?
No, actually the September figures are a little deceptive on account of the fact that in September the CP market rates were much higher. As a result, we were seeing a lot of oil demand, a lot of demand from AAA rated customers who normally go to the CP market. They had all come into the loan market, resulting in a more than 19% rise in the corporate loan book. That has already moderated in view of the fact that the CP market now is lower priced than the base rates of the banks, and therefore all of these corporates have reverted back to that CP market. Currently our loan growth is in the range of 16.5–17%, and we expect it will be around 17% mark also going forward.
So what's your guidance in your margins? Will there be pressure on margins going forward?
I would say that I don't really see any big downside to this, rather than saying what we will do, but the downside I think is limited.
So what are your capital raising plans for the year? There are reports that you're looking at a QIP somewhere in the second half of this financial year.
So at this point of time, anything else means we will try and go for the QIP for the equity portion. We might also do some tier 2 issuances. We have applied to the government. Once the government approvals are through, then we will set in place our plans, because it will depend upon the state of the market at that point of time. So it's a highly fluid situation, and we will need to take a call at short notice at that point of time.
So what's the latest on subsidiary merger plan? You've said it won't happen anytime before March 2014. Will it take priority next year?
So it all depends how we internally feel in respect of our requirements for more consolidation. Internally, I think we need to work quite a bit in order to set right a number of things, as well as to take forward a number of initiatives. So once we feel that there is stability in that, and we have the time and the effort that needs to be spared for doing these mergers, we will consider it then. But at this point, I think we have enough on our plate. We need to do a lot of work internally, and we intend to do that first.